China is now considering lifting its 125% tariff on selected US imports, including medical devices, industrial chemicals, and even aircraft leasing fees. The move comes amid growing domestic pressure and stalled diplomacy with Washington. While President Trump claims trade talks are moving forward, Beijing insists no talk unless all US tariffs are withdrawn. So what's really going on beyond this sudden policy shift? And why has the petrochemical supply chain become the new fault line in US-China tensions? This is not financial advice. No buy, sell, or hold recommendations. Always do your own due diligence. Trump recently raised tariffs on China's import to 245%, then lowered them to 145% under his Liberation Day plan. China hit back with 125% tariffs on US goods, reigniting the fiercest trade clash since 2018. While Trump insists talks are happening, Beijing demands all US tariffs be lifted first. Markets are rattled, and China's reliance on US petrochemicals is emerging as a major weak spot. One of the clearest signs of strain is coming from inside China itself. In a surprising move, Beijing is now considering removing its steep 125% tariffs on selected US imports, as a reversal that would have been unthinkable just weeks ago. The list includes critical goods like medical equipment, industrial chemicals such as ethane, and even aircraft leasing fees. This signals that pressure from tariffs isn't just hurting foreign companies, it's squeezing key parts of China's domestic economy. Hospitals, for instance, still rely heavily on advanced diagnostic tools made by US firms like GE Healthcare. And in the plastic industry, many Chinese factories depend on ethane sourced from the US Gulf Coast, material that's become harder to afford or reroute since the tariff war intensified. Even the airline sector is feeling the heat, as most Chinese carriers lease planes from Western lessors, and those costs have ballooned under the current tariff regime. According to Bloomberg and Reuters report published on April 25, Chinese authorities have already begun asking domestic companies to submit custom codes for US goods they want exempt, suggesting internal consultations are well underway. What's more revealing is that this isn't just economic strategy, it's also geopolitical signaling. Beijing knows that fully pulling back could look weak, but targeted exemptions allow it to ease internal pain without appearing to fall in the broader standoff. This is especially relevant as China prepares for high-level trade reviews with Europe later this summer, and wants to avoid looking isolated. In parallel, Chinese media have reported plans to waive additional tariffs on at least 8 semiconductor-related goods, although memory chips, including those made by US, from Micron, remain excluded. That exclusion alone is seen by analysts as a subtle, deliberate message. In short, China may be softening, but it's doing so on its own terms. The escalating trade tensions between the US and China are sending shockwaves through global markets. Major corporations like Procter & Gamble, PepsiCo, and LG have already revised their earnings forecast downward, citing the increased cost from President Trump's tariffs on China's import. Consumers are starting to feel the pinch as well. Prices for popular products from Chinese e-commerce giant Shein and Temu are expected to rise by up to 125% starting April 25, directly impacting shoppers' wallets. The stock market has responded with increased volatility. while some sectors like durable goods saw temporary boost due to companies rushing orders ahead of tariff implementation. Economists warn that this surge is unsustainable if trade tensions persist. In the commodities market, gold prices have dipped slightly amid hopes that China's consideration to suspend some tariffs could ease trade tension. Overall, the prolonged trade war is creating uncertainty across various industries, with businesses and consumers alike bracing for potential long-term economic impacts. Despite this shift, the bigger picture hasn't really changed. The US and China remain locked in strategic deadlock, each waiting for the other to blink. Trump refuses to ease tariffs without leverage, while Beijing demands a full rollback before even picking up the phone. It's a familiar standoff, but with higher stakes this time. The ripple effects are no longer limited to tech or soybeans. They are hitting the core of industrial supply chains and national economic security. The trade war is entering a new phase, more complicated, more unpredictable, and far more global. What happens next won't just shape trade between Washington and Beijing. It will redefine how the rest of the world does business. If you found this breakdown useful, hit like, subscribe, and let me know in the comments. I'll see you in the next one.